Hello and welcome back to Building Wealth on the Go, a podcast by KLT Wealth Management. Today is March 11th, 2025. We're back with season 6, episode 3 of our podcast. I'm your host, Brad Wilson, joined by my colleagues Courtney Beach and Joe Filiameni. Today, we're diving into our annual tax episode, a very fun topic, paying taxes, reporting on taxes. But there's a lot of fine detail when it comes to filing taxes. And so we're going to shed some light a little bit on some tips, tricks, what to look out for, how to prepare for next year's taxes, what you should be worrying about regarding this year's taxes and whatnot. So we're going to dive into that today. Then we'll touch a little bit on the markets and what's happening around the world before we wrap up today's podcast. So without further ado, Courtney, do you want to dive into some reminders heading into the filing season this year?
Sure. So this year, our filing due dates are April 30th for most people out there. And then if you're self-employed or a spouse or common law partner of somebody who's self-employed, your filing deadline is June the 16th, because the 15th is a Sunday this year, but you still have to pay your taxes by the 30th, no matter who you are. So those are your deadlines this year to remember. You also make sure that you have all your slips. If you're not sure, there's a couple of places you can check. You can check your MyCRA. That is the most reliable place to check because they have all your slips that the government has. Or you could check with your advisor and your investment team. If you're with us, that would be us. And just make sure that you have them all before you file. Do please remember that some investment firms will not issue their slips until the end of this month, the end of March. So please don't be overeager in filing your taxes. I know everybody wants to just get it done, but please make sure you have all your slips because you don't want to have to redo your taxes.
Yeah, it's kind of funny that it seems like receipts are coming out later and later in the year. I think all the investment financial institutions and investment management groups and stuff, they seem to be always, and there's some extensions as well that CRA does allow. But the unfortunate thing, we're still at April 30th on the filing of the tax returns, which means it really puts a big crunch for your tax preparer, or if you're doing it yourself. So there is a bit of a crunch date. I always maintain that they should move from April 30th to May 31st as a filing deadline, but that's just me saying that. So watching for your receipts, as Courtney says, is very, very important, and searching, making sure that you've got them. Most tax preparers will actually download your receipts directly from CRA's website. And that's, of course, assuming that CRA has them. So a couple of things have to happen. The investment group has to upload them to CRA. CRA has to put them in through their system. And then the accountant or yourself through your MyCRA access, you would then download them and prepare your tax returns that way.
Yeah, I think one important thing this year, we had lots of sort of chaos surrounding capital gains tax changes last year and everything, and sort of with all of, like the mail strike, the Canada Post strike at the end of the year last year. There was a lot of issues around donations. So donations was actually extended to the end of February. To make a donation and have it count for 2024, similar to your RSP contributions. And so you can still be getting in slips from those donation receipts, those charities. I know will be mailing those out for anything that happened in the first sort of 60 days of this year as well. So something to keep an eye on, and maybe you weren't aware that there was that extension if you were making any donations in January or February, that those can be counted towards your 2024 taxes. So
it'd be interesting to see if CRA decides to make that a permanent change, allowing the first 60 days for donations. It would be interesting to see the amount of dollars that went in, because obviously a lot of these charities, have been suffering. we're just kind of getting out of that COVID stage. We're 5 years actually today on the official announcement of COVID as a global pandemic. But um, a lot of those charities suffered during that time, and are still recovering. So having that extension, to me, it's a great idea. It's nothing like you kind of forget to do it at the end of December, but it's nice if you can do it in January and February, and it provides for some tax planning too. I think that's the important part of it, is that, okay, I'm figuring out my taxes. I have a rough idea of what my taxes are going to be. Hey, if I did a little extra to this charity, it's going to help my taxes and it's going to help the charity. So it would be interesting to see the results of that if they do share that information with us.
Yeah, it does provide a nice ability for especially people who are older and can't contribute to an RSP anymore, that don't have the ability to make any, pretty much once December 31st hits, that's it. It would be nice, but I know the main focus was the Canada Post strike, and they couldn't get any mail out campaigns done through November, December. The charities on sort of, looking for donations. So I wonder if they petition now, like you said, Joe, and say, oh, hey, look at all the dollars that flowed in during the first 2 months of the year. And, it would be great to have this extension, as a permanent thing. So, yeah, it will be interesting to kind of watch, but an important thing to also keep an eye on for your slips this year. So we're going to talk a little bit about installments. So installments, as depending on your situation, may or may not be applicable to you, but I think it's important that we dive into them, maybe what some thresholds are and whatnot, and why they're important to make your installment payments, and everything like that. So Joe, do you want to give maybe a bit of an overview on installments, thresholds, and what they really are there?
Yeah, so the requirement for installments, generally you get a notification from CRA, and that's generally after you filed your tax return, that you are required to make installment payments. And I believe the threshold was, correct me if I'm wrong, 2,500 or 3,000 owing in 2 consecutive years. I think that is the trigger point on that. And so then when you do get the letter from CRA, it's serious. You need to kind of really consider this. You either got to make those installments and make them on time, or you got to be relatively comfortable that your tax situation has changed so that you technically won't owe any money at when you go to file the income tax return. Because if you don't make those installments and they required you to make them, then there will be penalty and interest charged. So not a very, very happy surprise after you filed your income tax return. So it comes down to a bit of planning, understanding, why I am. There's a requirement for, it might be an isolated situation in one particular year. You got a bonus or something, or if you're retired and you got additional income coming in. So it could be just isolated in that particular year, and then moving forward, it's not going to be the same sort of tax situation. Just make sure that you plan that out, and you know your situation. Otherwise, you will get a penalty. I know in my years of dealing and doing tax returns for people that are self-employed, they can never understand the reasoning behind installments. And so I'm going to explain the reasoning behind installments is the fact that, it's a benefit if you're self-employed and you're really not paying any taxes until the end of the year, technically, right? Unless you are making installments. So the rest of us who are working for somebody has their taxes withheld directly at source. So it kind of puts everybody on the same level playing field, essentially, whether you're self-employed or employed, and you are prepaying some of your taxes. Essentially, that's the way it is. I know it's a concept that a lot of people starting off and being self-employed, they don't understand, and they do run afoul, in which case then they're always falling behind on their taxes. But key thing file your taxes. You can't be charged, as long as you file your taxes and file them on time. If you owe money to the government, that's one situation. But if you haven't filed taxes and owed money to the government, that's another situation that you need to kind of, seriously look at.
Yeah, no, I think it is really important for those self-employed, getting into the habit of putting away money for taxes, because it can really be a snowball effect. If you get behind on 1 year of taxes, you still have to pay taxes on every dollar you're bringing in after the fact. And if you're in a career where your income fluctuates significantly from year to year, then you might earn a lot of money 1 year, owe a lot of taxes. And if you didn't put that money aside, the next year your income's lower. You still have to pay current year taxes as well as back pay what you've missed. So it is really, really important to keep up with that, and really take advantage of that if you are self-employed, because it's going to be inevitable because the government is going to require you to do so. So get into that habit early, of putting money aside for those taxes each year. Some strategies when we look at installment payments, because there are scenarios where it is avoidable. I think one of the big ones is when you're in retirement. Sometimes clients can be hit with, I got a $3,000 tax bill this year, or $4,000 tax bill. And there's lots of reasons for that. Like Joe, you mentioned, maybe it's selling a rental property. Maybe it's, you've started taking CPP and OAS and you didn't really put any tax withholding on there. There's lots of other things that can add up. Investments did well 1 year. So I think that's where that planning aspect really comes in, and look at, where can you take off taxes at source, right? And we're flexible enough in where we receive our income, whether it's a pension through one of the big pension boards that you might have, whether it's CPP, OAS, your RIFs, you can all have taxes withheld at source for all of those. And I think it's important to see where can you take that extra money out and set it aside for taxes so that you don't have to worry about it when you're in retirement. So that kind of leads us into preparing for next year's taxes. And I kind of led in with the first one there. But Courtney, why don't you dive into sort of things to look ahead to for next year's taxes there?
Yeah, so you started off with taking extra taxes off of, your RIF and lift payments. You can adjust that every year if you need to, depending on how your income changes. So kind of projecting what your income's going to be for that year, and if you have changed your income, maybe making an adjustment at source, like Brad said. You want to track your receipts. Make sure you've got your donation receipts. Maybe have a little file folder where you put them so you can actually claim them. I mean, how many times do you have donations or health receipts and then you forget to file them because you've lost the receipts, especially when you get them this time of the year. So start up a file for next year. And then there's also, you can also do pension splitting. I know that Joe could probably describe pension splitting better than I can, but you can split your income with your spouse as well. So that could be kind of a strategy you can look at with your tax preparer.
Yeah, and just to clarify on the pension splitting, it has to be pension income, and the CRA doesn't consider OAS and CPP as pension income for splitting purposes. So it is things such as like a pension from a company, like your OMERS and HOOP and stuff, as well as your RIF payments and lift payments. That's is categorized as pension income, and essentially that splits. Now, in this world of technology that we live, you plug it into your computer, and when you're doing your tax return, I don't think I know anybody that's doing their tax return by hand anymore.
I know one person, Joe.
Do you?
One person.
Yeah.
Insists on
So
doing it.
it's a little bit more challenging when you do it by hand. When you plug it in the computer, it automatically tells you how much to split your pension. So it's relatively simple, and it's a great benefit for those that are at that stage, and they significant tax savings when you're looking at that. Back in the day, they did have regular pension splitting for non-pensioners, or I should say regular income splitting. It came in for one tax season, and then I believe then the government then removed it for
They
another 20.
realized how much money they lost.
Yeah, because it's significant when you, because as an accountant, as a tax strategy, we look at ways at trying to kind of split income. And that was a great mechanism, but we kind of lost out on that. But you will get that once you're into pensions and pension drawings.
Yeah, so that's great. So that's kind of a good gateway into next year. You've got some ideas, things to look forward to. You've got some tips and tricks. By the time this podcast comes out, we're about a month away from filing deadline and the tax deadline for when taxes owing are due. So make sure to get that all taken care of. Don't put it off. Go get it done in April here, so that you're not worrying about it or you aren't subject to any penalties or interest. So that wraps up sort of our main topic regarding taxes, and we'll touch for a few minutes here on the markets. And Joe, you mentioned 5 years ago today, COVID hit. Well, what happened during COVID? The markets tanked. And where are we today? 5 years later, we're doing something similar. So
we're tanking. Yeah. Well,
yeah.
I wouldn't say tanking.
No,
in this industry, we refer to it as adjusting, or it's kind of normalizing or whatnot. There's all kinds of adjectives that we can use, but obviously, like, we're in the heat of the tariff wars.
Mm-hmm.
We talked about it at our last podcast. It seems like hours don't go by that someone's adding a tariff here and a tariff there, especially here between U.S. and Canada. I think things are getting pretty heated right now, so we may be at a climax, and we'll start. Some senses will prevail. And we'll be able to kind of see our way out of it. Tariffs don't help anybody at the end of the day, and we're in this uncertainty is impacting the markets, and that's why we're seeing a drop in the markets most recently. This could be, by the time that this podcast airs, it could be all said and done and we pack it away, or we could still be in it. My bet is that it's all going to get all packed away. I can't see us, prolonging this in this the generation that we're in, and with all the technology and all the kind of advancements that we have, that we wouldn't move to more of a stabilized sort of global economy. So that's sort of my sort of take on that. But yeah, so lots of volatility that's out there.
Yeah, well, it definitely hasn't been anywhere near what we saw in 2020. Markets are only down a fraction of what they were in 2020, but it's still painful when the market sells off. Nobody likes it. It's not fun. But it is common. One of the things I saw is markets have we'll call it an adjustment. Joe, that's a good word. Adjust approximately 10% at least every 8 months. And so it happens often. We just don't like it when it happens. And so that's very normal in a market cycle, and we have to be aware of that. Now, of course, there's a lot of more outside noise causing a lot more panic and uncertainty, and that's what drives forces of some panic selling, some readjusting and everything like that. But like you said, Joe, I think it'll settle. I'm a little bit more in the camp of we're probably into April before we see it settle, because Trump's got his big April 2nd doomsday. Everyone gets reciprocal tariffs day. So I think that's going to pass, and then they'll say, okay, we'll all even everything out and shake hands and go our separate ways. And, all is good. We'll have coffee and dinner at Mar-a-Lago, and it'll all be nice.
Well, whenever it happens, it'll be because certainty has finally entered the market. Like, I think we can't emphasize it enough that market is not like uncertainty, and no matter where it comes from, as long as it's there, we're going to get these rocky markets. But as an investor, you got to think this is an opportunity for your portfolio manager to take advantage, because some of these companies are the price is undervalued, and they're taking the chance to make buys and sells and take advantage of the current circumstances. So you kind of, it's one of those times you got to test your risk tolerance, and are you comfortable? This is a question to ask that question. Are you comfortable? Are you where you should be? So talk to your portfolio manager about that.
Yeah. No, that's great. And so we'll wrap up this podcast, Joe, with your tip of the month.
Yeah, so really, I have nothing because the whole podcast has been tips about taxes. So we've given all the tips there. And then Courtney just stole my thunder there on the markets and the volatility and to talk to your advisor. So I think we're all good.
This whole podcast was a tip of the month. There we go. So your March podcast was the tips of the month there. Lots to take in, move forward, talk to your advisor. Connect, reassess how things are at, get your taxes taken care of, and then come back and listen to us in April after you filed your taxes for the next podcast. So thank you, everyone, for tuning in, and we'll see you next month.